Hello everybody, welcome back to my channel. And Keppel REIT has just released the first half 2022 results, and I have three observations you need to know. So the first of all, the DPU impact. Second, which I was very concerned about, and I wanted to check it out, which was the cap rates. And lastly, unless you're living in Jupiter, otherwise you will probably know that the Fed is raising rates really aggressively, and therefore the impact of rate hikes on this fella. So without delay, let's get on with business. So I think the DPU wise was a 1% improvement, and that was mainly due to the acquisition of a Keppel Bay Tower last year. So nothing too surprising over here, it's just pretty stable. I was quite surprised that the valuations actually rose by around 3%. So you see the NAV has jumped to 133 from 129. So at current share price of 110ish, it's quite a decent discount to book for this fella. The office's lease expiry profile looks very interesting. So if you look at the Singapore lease profile, the average signing rent in this first half was 11.3 PSF. But if you look at the average expiring rents of the leases in 22, it's going to be 982. So 982 is lower than 11.3, right? For next year is 1081. So this is also lower than this one. In 24 is 1072. So this is also lower than this one. So meaning to say that if rentals for offices continue to stay where they are, or even going higher, then when the time comes to renew the leases for the Singapore offices, there's gonna be quite a decent rental uplift from the pretty low base signed in these 3 years. And the amount of the leases concerned is quite substantial. So in 2022, you have a 5% expiring, right? So it looks like they're probably gonna be able to uplift the rent from this level to somewhere around here. And next year, you have around 13% expiring. And again, if they can manage to get rents to stay where they are, it's also a bunch of uplifting. And there's even more in 2024, right? 15%. So it looks like a pretty strong demand for grade A offices in Singapore. See the 11, the figure here, right? Versus the 9 and 80, 9 and 10 headline numbers over here. So it looks like a pretty good rental reversions positively for the next few years, barring a disaster in the economy, right? So that looks really interesting, and probably that's why the valuations are quite good as the rental prospects look good. So next component is the balance sheet against the impact of rate rises, right? So over here, there's gonna be a decent impact from rising rates, I think, because they actually perform the sensitivity to interest rates, and they tell you, right, that if you raise rates by 50 basis points, there's gonna be a 2% impact to DPU. So if you expect 1% rise in rates, then DPU will go down by 4%. So I think there will be some impact from rising interest rates. And that comes from two components, right? First of all, 73% of the debt is fixed. So the outstanding 27% of the borrowings on floating rates, they will get repriced as rates go up. So that's the sensitivity. And also, if you look at the debt maturity profile, 19% of the debt expires next year, right? So it really depends on what the Federal Reserve and the central banks do. So when it comes time to next year to refi this block over here, what will be the interest rate conditions then? I think they've actually refied everything in 2022 already, so that's not the big problem. So it's really this block and potentially this block that will get affected by the rate hikes and when it's time to reprice the loans. So that really depends on the actions of the central banks going forward. But at current levels, there's gonna be quite a fair bit of impact from the rising rates. What is very interesting to me actually is the cap rates. And I was quite anxious, eager to find out the effects. So if you look at the cap rates in Singapore, so this is for June 2022, right? 3 3.5, 3.3, is around 3.5% cap rates for Singapore offices, Grade A offices. I was quite surprised that the cap rates are so low, because the common thinking is that if interest rates go up, then cap rates will probably go up as well, right? As investors will demand a higher risk premium, but actually not really. So I went back and dug out the figures from December 19. So December 19, that's 2.5 years ago, right? If you look at it, Ocean Financial Tower in December 19 has a cap rate of 3.5%, and now it's also 3.5%. In fact, if you look at the MBFC, back then, 2.5 years back, it was 3.6, and now it has actually compressed to 3.3. So not only did the cap rates not go up, it's actually gone down. If you look at the ORQ, it was 363, and now it's 350, and well, these two are not comparable. We can see that overall the Grade A CBD offices had their cap rates all compressed, actually moving down. I guess this is a reflection of the phenomenon that we talked about just now, right? In terms of the strong positive rental reversions that is expected for the next few months, even few years maybe. Really depends on the economy. But the cap rates are really quite compressed, right? 3%, low 3% handle for some. Quite astonishing. Because if you look at it with the FOMC meetings coming up, we're looking at close to 3% federal funds rate by end of this year. So the federal funds rate is almost the same as the cap rate for Singapore offices already. So that's really spectacular, right? It's a convergence. And the phenomenon in Australia is also kind of the same, lesser extent though. So these are the cap rates for Australia and that for Korea. So they have one property here, right, in Korea. And if you look at it, 8 Chifley Square, 2.5 years ago it was 475 for cap rate, and now it's 463, so it has compressed as well. There's a bit of reshuffling of the assets over here in Australia, but the David Malcolm Justice remains, and the cap rate has stayed constant at 538. And if you look at Korea, 2.5 years ago the cap rate was 4.5, and now it's 385. So in Korea, the good quality offices also have their prime rates, their cap rates are compressing. So not just a Singapore phenomenon, but quality offices assets around the world has their cap rates compressing as well. So that's really remarkable, right? Distorting what you would think of as the relationship between interest rates and cap rates. And this also explains why the valuation and the NAV of the REIT has gone up. So the question now is, right, if the cap rates of office assets keep compressing, keep going lower, but yet the cost of debt keeps going higher, eventually these two guys are converging, right? And if that's the case, then what's going to happen to acquisitions of assets in the future? It's going to be difficult to get accretion, right? Because if you're borrowing at X and then you buy at X, then there's no accretion, right? So I think this is going to be an interesting situation going forward, and something quite very unusual, right? When you have interest rates and cap rates all converging. So it's really, really strange, but it's a reflection of the interesting times that we are in, right? Post-COVID and the midst of war and a flight to quality amongst geopolitical concerns. And which brings us to the last slide, which is the debt profile. And again, everything stems on the Federal Reserve's and the central bank's actions going forward, right? Are they gonna keep hiking rates, like going up, 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 up for a few years? Are they gonna raise rates once, twice, and then stay constant? Or are they gonna raise rates and then start chopping rates aggressively again as people start talking about a recession and the need to loosen the monetary conditions subsequently? So it's difficult to say, right? Because if you think about it, they're raising rates to combat inflation, right? And the inflation is a function of oil, right? And the oil is a function of the Russia-Ukraine war, right? So to predict the trajectory of interest rates, you need to first predict the outcome of the Russia-Ukraine war. For that, I think I can only ask one guy, and that's Vladimir Putin of Russia, right? It's difficult for the common man to say though, so that's something to chew on and think about. So good luck, dude. So we have reached the end of this video. If you like what you saw, remember to subscribe over here, like, share, and comment. See you very soon.